So that will be all for today. So I believe that we are all together and we can now go ahead. So I'll be starting just as we introduced from definition of withholding taxes. We all know that withholding tax is more of tax and advance payment of tax. Withholding tax is an indirect form of tax which deals with income of individuals, deals with income of income from companies, income from partners who are in partnerships. I guess we understand withholding tax has to do with incomes earned by, that's the base value now, income earned by partners who are in partnership, by individuals, by enterprises, by companies. Now, what's the operation of withholding tax? How do we apply it when we talk of, in terms of definition? Everybody believes that withholding tax, as the name applies, is an advance payment of tax. That is, you as an individual, you do a business with, it can be customer to customer, that is an individual to individual. It can be business to customer, that is a business to an individual. What we are saying here is for every income you are supposed to earn for a service rendered or for a product sold, there's an amount of tax you are supposed to pay. And that tax, for example, if you are a company, you're supposed to pay company income tax. That is based on your self-assessment. If you're an individual or an employee, for example, you're supposed to pay PAYE. So what we are now saying under withholding tax now is you are not the one paying the tax. It's the third party who you have done business with, who is supposed to pay you for rendering that service. Or as an individual, you offer a service or you sell a good. What we're saying now is, in the course of being paid for the product or for the service you have rendered, there is a deduction or there's a depletion on the total income to be paid to you. That's what the law is saying. Why did this law come into existence? We are still under definition. This law came into existence purposely because of there are lots of people who do contracts with government. We used to call them briefcase contractors. So when they do business of an office, they only have a registered. So this now necessitated the fact that for people like this to be brought into the tax net, government or individuals that they do business with are expected to deduct a certain percentage from their income, remit same to the government, and the government will in turn issue them what we call credit notes. At the level of an individual, yes, credit notes are issued. At the level of a company, credit notes are issued. So as time went by, the history or the applicability of withholding tax started to expand. And in that expansion, that now takes us to what we call legislation today. So what that happened on the long run is that withholding tax became acceptable by Company Income Tax Act, and also that's the withholding tax now became acceptable to company income tax under section 79, 81, and 82 of the Company Income Tax Act, Cap C21 LFN 2004. Even the petroleum profit tax too also applied the income tax in section 56, 1 and 3. Then the personal income tax also made withholding tax applicable in section 69, 73, and 74 of the Personal Income Tax Act, Cap P8. Now, under personal income tax, when we now go to, okay, before we go to the rates, we talk about filing period. I hope, okay, let me go over the legislation again. Now, what we are trying to explain here is that because of the advantage or the way withholding tax became known and it was very effective in providing revenue, because the bottom line of every tax is to be able to provide revenue for government. So the application of withholding tax now had to be accepted. Now, under petroleum profit tax, it was accepted. They now brought it into their law under section 56, 1 and 3. Company income tax also talks about withholding tax under section 79, 81, and 82. Personal Income Tax Act 2 talks about withholding tax under section 69, 73, and 74. Now, we also know about the FRS Establishment Act, which was propagated or came on board in 2007. It also spoke about withholding taxes under section 40 of the FRS Establishment Act 2007. So in all of this, we see that withholding tax has become very advantageous to the country and also to some companies. I mean, that is why you see that electronic printing of credit note, though it was cumbersome at a time, but I don't want us to go into all of that. We've gone out of that shelf for now, though there are still some little issues in getting credit notes to offset your taxes. Now, let me quickly give a brief of credit notes so that we also understand the advantage of withholding tax to a company. Now, once withholding tax is deducted from you as a company or as an individual, you are supposed to have the advantage of using that to offset your taxes, but it is not automatic until Tax Pro Max now came on board for the companies. But for individuals, till now, it's still a tug of war. It's still very difficult to get your credit notes to offset your taxes as an individual or as an enterprise. But for companies, it's getting better by the day, because now it's easy to say that taxes will be deducted from you and use them to offset your taxes in the future. In practical, once you don't have evidence of those credit notes, they used to be handwritten at a time. It was now being printed by soft. But as it is today, you don't even need the credit notes anymore. It goes automatically into the Tax Pro Max, and you can now use it to offset your taxes on the Tax Pro Max. That is as a company. So we see that the withholding tax has a long way to go in terms of becoming advantageous to a company or to an individual, especially, or an enterprise, or in partnership too. It's still a very difficult process. But for the companies, it is better for now. But for the revenue, on the revenue side, I mean, it's a very good advantage for them. The withholding tax is performing better because there's a lead way and there's more of clarity as it is. Then for the filing period of withholding taxes, what is expected of companies or individuals who deduct and who have the onus to remit is to be done on the 21st day of the succeeding month. A failure to do this, there is 5,000 for each month of failure. Then this now takes us to the rates that are applicable. For the rates that are applicable, we have a long list, but I would have wanted us to, from dividend to interest, we have 10%. For companies, the withholding tax payable are due to the Federal Inland Revenue Service. for previously for persons, individuals, enterprises, partners who are in partnership, who are residents in FCT, the withholding tax due payable was to be paid to the FRS also. But as we all know, the FCT now has FCT Internal Revenue Services. So for individuals, enterprises, and partners in partnership, the withholding tax due payable will now be due to the FCT IRS. While for withholding tax on non-resident companies or individuals who carry out businesses in Nigeria, the withholding tax due payable is to FIRS. While other state internal revenue services are in charge of withholding taxes due from individuals, enterprises, and partners in partnership that are residents in other states. So as it is, that's the jurisdiction for each of, on this basis, where we have companies, partners, and partnership in partnership. Then we'll now look at, for the rates, we know that building and construction was reduced to 2.5%. This was done sometime in 2015. Then it was reversed, but as at 2021 Finance Act, the building and construction rate has been moved to 2.5%, excluding survey, design, and delivery. When we look at the recent trends as it concerns the rates that we are talking about, we have areas of ambiguities. Number one, let's look at for building and construction. Now, there is a question that is being asked that those in the petroleum profits upstream sector, those who are in the upstream sector, in the oil and gas sector of the economy, that build rigs and all of this, are they also included? Because the law specifically said building and construction. And the essence of reducing the 2.5% on building and construction was because most of the construction companies in Nigeria, like Julius Berger, Arab Contractors, and co., came up with a very strong template and complaint that, look, you are charging us 7.5%. Let's even go back to where they started from, that they are charging them 5% of withholding tax, and they are charging them 5% of VAT. And the way they work is that most of them work, 95% of their jobs are carried out with government officials. So the bottom line, they have issues with margins, losses, and profits. So government looked into this and decided to reduce the withholding tax rates to 2.5%. But in a reduction of these rates, when we are talking about tax laws, the connotation or the wordings matters a lot. So on the side of the revenue, what they were looking at are those who are into building and construction of roads. But now it needs to be explicitly stated, because this now includes companies in the oil and gas sectors who also do construction. So these are, we are still in between. So all of these now have to deal with understanding of each consultant and how he or she wants to handle the issue. For now, there's no court case clearly stating where they fall under. So those are trends in terms of rates that we are looking at. Then the basic issue and the big elephant when it comes to rates as it relates to withholding tax is what we call contract and supply. The series of circulars trying to explain, try to figure this out. But in practical terms, you find out that once you are under an audit by the tax authority. They will pick all your transactions. What is the understanding of contracts, withholding tax on contracts and supply? What is the meaning of contract? At a point in time, the revenue explained it that, look, if somebody, you go out there and you buy, even when you go to the open market to buy, but they now notice that you are buying from this person repetitively. So whether you sign an agreement or there's a contract document or not is none of their business. It's not. Once it is repetitive, they believe it is now a contract or supply. There was a point in time too, revenue believed that once you carry out any transaction that is not on cash basis, you issue a check, it becomes a contract. So all of these, they've all been disputed. And as time goes on, revenue has also tried to clarify that truly, because you issue someone a check doesn't mean that it's a contract of supply. Or because you buy from an individual doesn't mean that it is a contract or supply. We all understand this, but the practical thing is that once they come or you are being investigated, they still try to say, look, as far as you are doing all of this, it is a contract. So it's good that we understand all of this. So as time goes on, there are court cases that back some of these issues up that we can use to substantiate some of this position as it is. What we need to know about contract or supply again is documentation. There should be proper documentation to show that whatever we are doing or whatever we are buying is from the open market and there is no issue of contract and supply, whether you pay with check or you pay instrumentally. That's another angle the revenue was looking at, that if you are not in a contract with anybody, how can you now buy and pay later, or you now pay instrumentally? I mean, it doesn't matter that you are into those doesn't constitute a contract or supply. A contract or supply should be properly documented and all of that, showing that it is a contract. And the major reason for applying that contract or supply are more of people who, for example, let me cite an example for clarity. The easiest example is diesel, supply of diesel. Now, for example, supply of diesel, if you are buying directly from Mobil, that's in the ordinary course of business, the revenue will not disturb you. But if there's a third party in between that buys from Mobil, now charges you a little margin, charges you a little margin, that margin will be subject to withholding tax. And this is where documentation also comes in. Likewise, for example, you purchase an asset, there should be clarity. For example, you are buying an asset, revenue will charge all of it to withholding tax, believing that it is contract and supply. Because the example of buying diesel is very obvious. Everybody knows Mobil. Even the cars you are buying, if you are buying from Coast Charis, they know that that is their ordinary course of business. You want to buy roofing sheets, for example, and you go to a roofing sheet company to buy, that is ordinary course of business. Now, let's move from these rates to documentation at this point in time. Now, when we talk of documentation, let me go back to the example of buying diesel from Mobil, for example. Most companies, when they use a third party to supply, the third party will issue the invoice such that the invoice doesn't show the service rendered. It will just show that diesel of this amount or this quantity was bought and this is the amount. So on one hand, we've given room for the total amount to be subject to be a subject of withholding tax. Now, what are we supposed to do? There should be education of these suppliers, for example. If you're buying diesel from a third party, or a third party is supplying you cars from Coast for example, the cost at which is buying or the rolling rate of the diesel should be stated, while the service charge amount would also be stated separately. So the service charge or even the transport cost, some of these suppliers will call it transport cost. The transport cost should be stated. So it is that amount on the transport cost or the service rendered that should be subject to, that should be a subject of withholding tax. Likewise, the plumbers, the carpenters, those itinerant workers, that is where most people also have issues with audits involving state governments. I mean, you have all your documents perfect, you don't have anything to hide. When they are reviewing your invoices, what that happens is all the amounts will be captured. No. You educate the itinerant vendors that, look, when you are working, your receipt, even the mechanic, the receipt will show cost of the products he bought in terms of spare parts or in terms of parts is going to fit, down to AC, office fittings and furnitures. Then the service rendered, some of them will call it workmanship in the local term. So I mean, the workmanship is what is now subject, or what will now be a subject of withholding tax. So once we do this, it has a way of reducing whatever withholding tax amount would come up. Now, but in general practice, for example, in the oil and gas sector, or in some of these conglomerates, what usually happens is they will tell you that, look, your company must be a limited liability company. It also happens in our financial institutions now, where you want to do a contract or you want to do a job with them, they will tell you that the company must be a limited liability company because they are trying to guide against duplication of withholding taxes and all of that. But this is as a result of documentation. Most of our offices, as we know, documentation is a very big problem. So that's what happens in terms of documentation. Now, to guide against this, or the cumbersome nature, or the fact that you now have to start educating a plumber or someone supplying diesel, that look, these transactions are subject to withholding tax. Because some of these laborers or itinerant vendors, on a good day, they are not subject, they are not in the tax net. So that is the advantage of withholding tax. You are acting as an agent now to the government to deduct and remit. So when the government comes to check your books, of course, they will check, did you deduct from this person? Did you deduct from this person? So most of the conglomerates, oil and gas company, bank, and other financial institutions, why they always request that it must be withholding tax, a company limited company, is because they don't want to go through all this rigor of documentation. So from onset, once you are dealing with them, you know that the whole of the transaction is subject to withholding tax. They automate it. So that is why you see that once you are doing business with this group or this sector of the economy, they charge withholding tax on the total amount and they remit as at when due. So we can now go to, I don't know if we have any questions for now. So that. Hello?
Yeah, so someone was asking, is there no slide for this training? Because it helps for you to be able to follow when someone is speaking and you're looking at what is being said. You can make notes and all that.
Apologies that the slides is not available for now. I actually got in late. You know, we even had to postpone this lecture till today. I'm actually bereaved, but I had to tell my boss that look,
Sorry about that.
let's still continue. My apologies. I'm going to make the materials ready, and I just had to make sure I do this so that going forward, this will not happen again, okay? I know the slides are quite important. That's why I'm taking it and repeating some of the things I'm saying as slow as possible. Sorry about that, madam. Okay. So I think we can go ahead. The final thing is there are actually some transactions due to the nature that are not subject to withholding taxes. That's what we're saying.
I'm going to draw you back a bit.
No problem, sir.
Yes, this withholding tax thing. I mean, does it, for example, depending on the kind of business that your company is into? For example, where I work, we are into, well, more or less consultancy.
Okay.
So what we do is that we do projects for donors. So they are donor-funded projects.
Okay.
Okay. So, yes, so we will have vendors, all sort of vendors. So sometimes there's always this issue of when we do workshops and people cater. I don't know if this is not where I'm supposed to ask this, but I just wanted to chip it in because you've discussed about contracts and supplies. Because there's always this issue of
Hello?
Hello? I know that
sorry, I lost you there. I lost you. Hello?
So I was saying that, can you hear me?
Yes, I can hear you now. I lost you at the point you said you do workshops.
Yes.
Okay.
So when we do workshops, we sometimes we have to use hotel rooms and then use hall, and then there will be supply of probably tea breaks, lunch, and all sorts. So at the point where invoices are raised now, sometimes it's an issue. The hotel themselves sometimes don't even understand what withholding tax we are supposed to deduct. Some do, some don't. Yeah. So, but what we've tried to do in the past, I don't know if this is right, is to charge on the hall, on the rooms, and then we leave out the food. That is one. Then for where we do not use rooms, just maybe a workshop where you ask a vendor to supply food. If food is not charged from a hotel bill, why then am I supposed to charge from an invoice sent by a caterer? Because it's really confusing.
Well, yes, exactly. That's a very good scenario. In all of this, honestly, both the food, both the hall, both the hotel services are subject to withholding taxes. But they try to, some people claim ignorance. For example, like what I was saying, if that same hotel was going to do any business with Shell, with Mobil, or with the banks, for example, a bank is coming to make use of that hall, they won't tell the bank that, because the bank will tell you from onset, for us to use this place, we are charging you withholding tax. It's like they've made it a norm, all these organizations. But once they are dealing with an enterprise or companies that don't have clearly stated, that is not clearly stated, they start arguing back and forth. And that's why I gave the history of looking at withholding tax from the side of companies. No company wants you to deduct withholding tax from his money, because the evidence, we say an advancement of tax, but in practical, the advance payment is not there because you don't have your credit notes. In fact, there are people that have to pay percentages just to get their credit notes to be able to offset their taxes. So no company wants you to deduct withholding tax from his monies. Or it's like the vendors we are talking about, the itinerant traders, the laborers, and all of that. Some of them, once you tell them you are going to deduct withholding taxes, they will walk away. Let me cite another example for you that is very common, very common. Rent. Even you as an individual, when you are paying your landlord rent, you are supposed to do withholding tax. Withholding tax on rent is 10%. Even from companies, some landlord will tell you, look, if you are going to deduct withholding tax, I don't want you to stay here. So in practical terms, it's difficult, but we now know how to manage them. And the truth is, on the long run, is your organization that will now bear this burden, because the person you did business with did not allow you deduct and did not allow you charge. So once the authorities come to check your books, for example, and they see all of this, they'll pick that amount and expect you to have deducted and remitted. So the shortfall, you find out that you end up paying it. So those are some of the issues. That's why I said, let's look at the practical of all of this as to the law here and then. Let's look at the applicability, which is very important for all of us. Then documentation too. Documentation is very, very important. When it comes to withholding taxes, is very, very important. Whatever transaction you are doing with anybody, it's good to get a clarity. This transaction I'm going to, at what point will withholding taxes be charged? Another angle I want to bring up again is the fact that the way withholding taxes works, previously, everybody was of the notion that it is only when you pay that you charge withholding tax. No, withholding tax is not on payment. Whichever comes first. If, for example, you prepare an account for 2022, you charge an audit fee, for example, in those your accounts. That audit fee is subject to withholding tax in 2022, even when the audit fee has not been paid, as at 2023. That's an issue again with withholding taxes. So once they come and they see it in your books, they will pick it. Previously, people never knew. We used to think that we could run away from it. But as it is now, once you charge it in your accounts or in your books, you have to pay it. So, Madam Ndidi Amaka, I hope we are good.
Yeah, I am.
Okay.
I am.
So we can move ahead. Finally, I want us to look at an angle in withholding taxes. The only incomes that are not subject to withholding.
Sorry, there's one more thing. Sorry, one more thing. I put them down before I ask the question.
Okay.
Fuel and diesel. When we make purchase on fuel and diesel,
yes,
I am not able to deduct withholding tax because the fuel comes. It's just like we don't buy directly from the station. This thing now is in the north, so we don't buy directly from the station. So what we do is that we have a company that I think they do whatever they do.
They supply you
exactly.
Yes.
Yeah. So when they send their invoices, they don't put withholding taxes, no VAT, no nothing, and I'm at a loss of what to do, because I know that if I buy from the pump directly, I'm paying. I don't know how that works anyway, but it's sorted there. But this is a company to another company. Ordinarily, there should be VAT and withholding taxes included in the sorry.
Exactly.
So, but this is not happening because I'm conscious of the fact that at the end, like you said, when your books are maybe an audit happens, like tax people come in, and what defense do you have? Exactly. And then they will say that they are selling petroleum products that you're not supposed to charge them withholding tax.
No, you do. No, you do. You do.
So I need some clarity on this, please. Because going forward, I want to do things rightly.
We'll get to that point of VAT, but even VAT, petroleum products are subject to withholding tax. They're even subject to VAT because it's just that you don't charge the VAT. It's inbuilt. It's in arriving at the total cost, they would have built it in. So that's how that works. But for withholding taxes, some of these things we need to, is about educating these people. It's a difficult thing to do, honestly. But you need to let them know. Some clients, what we ended up doing is they can't do away with some of these vendors because they stay with those vendors over time. then those vendors, such is that if you look at the cost they've incurred in supplying that diesel and fuel, the price is very, in fact, at times the stress you go to getting it from the filling station itself is cumbersome. So you find out that you can't just tell them to go away, but you need to find a way of educating them, even if it means showing them like tax reports that says, look, this diesel is subject to withholding taxes. Or we give you a section of the law that says, look, this is a supply and is like subject to withholding taxes. But what they can do, just as I explained earlier, for example, if they are buying from the pump price at 100 naira per liter, they should state it on the receipt. Then the difference of what goes to them can be, maybe they're charging you like a service charge or an admin cost, or maybe a supply cost. It can be a supply cost. The supply cost can now be a difference of maybe 10,000 on that same receipt. So you tell them that you are also trying to guide against and also assisting them going forward. I mean, it's a roundtable discussion. I now come to a middle point. So the middle point is the fact that, look, let's agree this is what's going to be the actual cost of the diesel. And your service cost or your service charge can be 10,000, can be 20,000, can be any amount suitable as it is. Then is on that amount, they will not charge VAT. You will not charge withholding taxes.
Okay, that makes sense.
So with that, I'm sure they should be able to budge and see reason with why you're doing all of this. Okay, so let's move ahead. Finally, exemption. There are some income that are exempted from withholding tax. Insurance premium received by insurance or their stockbrokers. Insurance premium, both life and non-life, are not subject to withholding taxes. But the commission paid to the brokers are actually subject to withholding taxes. Then income from turnover, that's a dealership and distributive trade. That's, for example, some people, what they do is they really don't have a company. Some even have a company. We have what we call dependent and independent distributors. Now, dependent distributors are such that it doesn't really have an outfit. Some do have a warehouse, but what they do is that they sell at the company price. They assist the company to distribute. They tell you that, look, we have this product, we have this product. They sell not even at a margin, but some, of course, can sell at a margin. So what we're saying now is that their income, that distributive trade income of those dependent agents is not subject to withholding taxes. But the commission paid to those agents is subject to withholding tax. Then some of those agents, okay, in other companies, we call them marketers. We have what we call permanent marketers and contract staff who are also marketers. So what we're saying on one hand is that those who are permanent staffs, who are marketers, at the long run, you pay them salary. That salary will be subject to what we call PAYE. The contract staff, who, for example, we can take to be the dependent marketers or dealers or distributive traders, they earn what they now call commission. So what we are saying is that whatever they sell, that income is not subject to withholding tax. That's, let me give a typical example. I'm selling for Coast Charis or I'm selling for Mobil, but I'm acting on behalf of Mobil. That is where we draw the line between the example Mrs. Ndidi Amaka gave us just now. Those are independent marketers. But once you have an independent marketer, that contract or that sale is not subject to withholding tax. It's as if you are buying directly from Mobil. So it is Mobil that now pays him his commission. It doesn't earn a commission from you. Instead, what he's earning is the cost of that product which he sells. But an independent marketer will charge you a commission, will charge you a service fee, will charge you transport cost. So that is what we are talking about here. That once you have a dependent agent, what he sells or the income that comes from such sales is not subject to withholding, is not liable to withholding tax. But the commission he earns, of course, is liable to withholding taxes. So I think that's all we have for withholding tax today, except you have any other area or any current trends we want to talk about, or any pending legal case in the office, or that we know if we want to talk about before we move over to value-added tax.
Yeah, so it's about this, the rates now.
Yeah.
Because some people will say to you that you're supposed to charge 5%. Some will say to you that you're supposed to charge 10%.
Okay.
I have understanding that if a business is limited liability company, it should be 10%, irrespective of what they are supplying or the service they are rendering, and the rent. So if it's maybe like a business venture or business registration, then it should be 5%.
Yes, yes.
I just wanted you to talk about this rates.
Rates, okay.
From the services.
What I wanted to do, I'm sure we all have your emails. I was going to send you the table. There's a table I prepared with little notes. Okay, but quickly, since you raised it, we have two types of rates. One is for company, one is for individual. Now, when you come to practical terms, how would I say it now? Take Mr. Biggs, for example. Mr. Biggs is a business name. It's not an incorporated entity. So when you do business with Mr. Biggs, like an enterprise. So practical in your schedule, going forward, what I want us to gain here quickly, every company should have what we call a vendor schedule. That vendor schedule should be prepared using the vendor's certificate of incorporation. You'll be surprised that the vendors you are dealing with, or the names you are using, or the names in their banks differs from the actual name of the company. Mr. Biggs, for example, is owned by UAC. 9060bet, for example, is owned by Winners Bookmakers. That is the incorporated name. Is it NigerBet? I think it's owned by KC Gaming. So some of these companies, likewise some individuals, what they do, they give you their bank name that they use for business. In those names, you can even have something like Ellis Nigeria. That's what the bank name shows, because they don't want to show that they're a limited liability company. You just say Ellis Nigeria. Even some on the letter-headed paper, you won't see limited on the letter-headed paper. So when that happens, you now start treating that company as an individual. When you are charging the withholding tax, you start charging that rate as an individual, which is wrong. So we are talking practical now. So what we also do on the long run is, there are some companies you ask for their incorporation. Once it has RC, that is a registered company. Once the company has BN, that is a business name. That also assists us to differentiate which is a company. Like the company that will be Ellis Nigeria now, if they send you the RC number, you see that it's RC. But they could send it to you and it will be BN, then you can now actually assert, okay, we treat this company as an enterprise, because this would assist in determining what rate to use. That would determine to know what rate to use, the actual name of the company, the incorporation. Once you are creating that vendors list, make sure you are using their certificate of incorporation to create. Anyone that doesn't want to send to you, you can request for their RC number, or you check on their lettered paper. Some have RC number on invoices. So these are areas you can actually confirm whether they are a company or individuals. So once this is confirmed, we can now start to determine the rates. For companies, for example, dividends, interest, and rent is 10% for both company and individual. If you remember, I mentioned rent the other time. The landlord who doesn't even have a company, who is an individual, they're supposed to deduct 10% from his income or from his rent when he's being paid rent. Then interest charge is 10%. Dividends paid to companies or individuals is 10%. Then directors' fees paid to directors is 10% withholding tax. That's majorly to individuals. Then hire of equipment, which is more like rentals, is also 10% for both companies and individuals. Then royalties paid, especially in the petroleum industry sector, to companies is 10% and to individuals is 5%. Then we have what we call commission paid to agents, we also have commission paid to individuals, commission to companies, consultancy fees to companies, technical fees to companies, service fees to companies is 10%. Same, commission, consultancy fees, technical fees, service fees to individuals is 5%. Then we have management fees. Management fees paid to companies is 10%. Then management fees paid to individuals is 5%. Then we have construction. You know, I discussed a bit about this construction of roads, buildings, and bridges. But this is still here nor there. To companies is 2.5%. That is construction. To companies, this is a peculiar one, is 2.5%, while to individuals is 5%. So this is only type of payment that where you have withholding tax deducted from individuals is higher than that of the company. The contracts and supply other than sales in the ordinary course of business is 5% to company and 5% to individuals. So are we good?
Yeah.
Mr. Clement. Good afternoon, Mr. Clement. I was going to ask a question. Yes,
okay,
please. Okay, thank you for the analysis so far, and I think you've answered virtually all the questions, but talking about documentation, which you spoke about when it comes to withholding taxes, you know, by vendors, that whenever they are sending in their invoices, they should kind of break it down in such a way that it shows, you know, the cost, and then it shows the service charge.
yes.
You know, so I work with an audit firm,
Okay.
and then we are also a consultant, you know, of State Inland Revenue Service. Most times when we go to the field, we have challenges when it comes to this because it's not expressly stated in their invoices. All you just see is a lump sum amount,
exactly
on the invoice. Yeah, so it becomes an issue. What we do is we just pick the figure. But in terms of giving them that orientation, we are not the one to do that. To be giving them orientation. This is how you do it. This is how you do it. Going forward, what do you advise that we pick as the figure?
Okay, it's good to have somebody who is on the government side. I won't say on the government side, but I mean looking at it from the government angle. Now there are two things. First and foremost, let me talk about the audit you go to do on the field. Now, what I tell people is audit is not just about compliance or raising liabilities for companies to go and pay. Of course, I know on the side of the consultants to government, minus meeting targets, you have commissions based on the liabilities and all of that, okay?
Yes.
It's also very good. It's also very good to educate some of these companies, many of them. That's why I had to take my time to explain documentation. Documentation is various angles. Now, we've looked at it from the angle of how a company should document, how a company should interface or communicate with its vendors. Then in the other case of where someone is not even charging you VAT at all. So why are you charging withholding tax in the first place? Yes, it still makes it chargeable, but there should be an understanding between both parties. But from your own end, I mean, the onus is really not on you. But the fact is, as far as you're an auditor, you have that, how would I put it, like an obligation, positive, which is not compulsory to tell. So many people don't know. There are so many companies, I'm sure you go to audit, they don't even have accountants. You find out that maybe it's the HR or the IT person or the MD handling those accounts and all of this. You even have companies you go to, the accountants would have probably briefed the directors of those companies. Let's do this, let's do this. Some of them don't even know the importance of why the accountant is telling. But when you now come and what the accountant has told him is what you are now explaining again on the field. I mean, you will now start having a rethink that, look, if the accountant has said this, the auditor has said this, let's change our system. It's for clarity. And on one hand, minus the financial aspect of it as a consultant to a state government, the fact that, take for example, an auditor who knows his onions and sees what you have captured, that case that should have been resolved in 1 month can now take you the whole of back and forth. And what is putting on his template as an objection is actually valid in the sense, for example, that we talked about. We know that if you are buying from Mobil, or the fuel you are buying is not supposed to be a subject of withholding tax. But because the third-party delivery, in the course of reviewing your documents, okay, this man, at times they buy from Mobil, at times they buy from third party. Now, the one they bought from Mobil, you did not capture. The one they bought from third party, you capture the whole cost, 100%. Know that you can't capture this 100%. And you now start talking about how do we draw a line. So it's either it now becomes favorable to him or it becomes favorable. Yes, they'll continue to drag it. Point. But the going forward after today, for understanding, we as auditors, we as consultants, we have a job both the ones that pay us and the ones that don't pay us. It makes the world a better place. And the truth is, you're making a good name for yourself, because minus just going to the field, the understanding or even the environment, they will know that, okay, this madam actually knows what she's talking about. There are instances where I know auditors go to the field and they'll call the accountant and say, look, why are you doing this? This is wrong. Why are you wrong templates for PAYE, or is charging a wrong withholding tax rate? You understand? The onus, yes, you just educate them that, look, no, your audit fee shouldn't be 10%, it should be 5%. I mean, therefore, or they mention your name, say, I know it was this person that. So those are the non-financial benefits we get as auditors or consultants. I think that's okay. Are we good with that?
Yes, thank you.
Yeah. Okay. So I think we can move on to VAT. So let me give a quick brief on VAT. VAT is something I know that we are all used to, and it's subject to so many things, but we'll be looking at the practical aspects of VAT in our environment or office today. Now, from the content I have definition, registration, filing dates, jurisdiction, exemption and threshold, then current trends. So without wasting much time, we'll go to definition of VAT. Hello, can I go on?
Yes, I can hear you.
Okay. So for VAT, VAT is a consumer tax. In when we say consumer, that is final consumer, is the person who is supposed to bear the burden of VAT. In the layman terms, VAT is a tax on spending. When you spend, I go out, whatever you want to buy, you are paying VAT. VAT is like part of life. Whatever we do, there is a little VAT charge. So what VAT does is that from the supplier who supplies the manufacturer in turn sells to the wholesale. There's a VAT at the supplier level, there's a VAT at the manufacturer's level, there's a VAT at the wholesaler level, then there's a VAT at the retailer's level. From your Uber driver to Bolt driver to your eatery to the Mr. Biggs to the everything we do, buying of clothes, all of these people from supplier, manufacturer, wholesaler, retailer, they are all in the channel. They are all agents of government for collection. They don't, at any point in time, bear VAT. Now, those who are supposed to bear VAT is me and you, the consumers. Whatever product you are consuming is subject to VAT, except some services or goods, which we're going to talk about later as we proceed. But it's good to understand. Why I'm saying this in the definition is that we need to understand it. I'm sure some of us are accountants in companies here, and some of us file VAT on behalf of clients and all of that. Now, there is always a usual complaint that, look, where is the VAT? They don't see the VAT in their records. They don't. This takes us to record keeping. Anyway, we know that accounting, auditing, consultancy, anything assurance service always starts from bookkeeping, which they taught us all the way back from primary school. That's what I tell people. That word bookkeeping is very relevant in everything we do in our assurance, accounting, and audit lifestyle. Very, very important. But you find out that so many companies, at the end of the month, when it's time to create VAT payable, some companies, honestly, will not see the value of that VAT. You compute VAT, and this is the amount you are supposed to pay. You don't see it. You don't see it in the bank. You don't see the cash. You don't see it in your books. You're always balancing from here or balancing from there. So that's why the Finance Act 2020 has also made VAT on cash basis. Now, VAT is on cash basis just to reduce some of all these hiccups. So that's why I said VAT is a consumer tax from the definition. It's on spending. It's not on the company. Even you that render audit or financial services, you have no business with VAT. It's your client that is supposed to pay that VAT. It's your client that should pay that VAT. So those are the trends or current issues when it comes to definition of value-added tax. Now, we now move to registration. Now, the purpose of registration basically, registration basically is for new companies. But the revenue does not really pay particular attention to this, except for where the company has been registered for a long time and refused to register with them. By law, a company that is newly registered after 6 months is supposed to have registered with the relevant tax authorities, which is the Federal Inland Revenue Service. Failure to register attracts a late registration of 10,000 naira, while subsequent month is 5,000 naira. But as it is for now, because the revenue, I presuppose, they want more people in their tax net. So they really don't dwell much on these fines. They encourage everybody to register. While the filing dates for VAT, as we all know, is the 21st month succeeding the month of transaction. That is, the transactions in January will be filed before or before 21st of February. Now, we know we have the oil and gas companies that deduct VAT at source. So what the law has done now from the recent Finance Act 2022 is that all VATs deducted at source should be filed on or before the 10th succeeding month. That's for those in the oil and gas company that have deducted VAT at source. They should file. For example, if they've deducted in January, before the 10th, on or before the 10th of February, they should have filed with the Federal Inland Revenue Service. Now, the jurisdiction for VAT is Federal Inland Revenue Service. Of course, when we talk of current trends for VAT, we know that recently there is an issue that is in the burner. But as it is, I think politically that issue is, as we put aside, let's not say put to rest or settled. The issue is not settled yet, because till now we have the issue of double taxation when it comes to value-added tax. Just as I said, VAT is on consumption, on spending. Now, in some states, you have what they call sales tax or consumption tax. Let me take Lagos State as a case study when it comes to jurisdiction here. We remember that Rivers State raised the issue that VAT should be revenue should be due or handled by the states. And if you look at the concept or the history or the beginning or application of VAT from onset, it was supposed to be the state actually. But if you look at the state tax machinery, I mean, they don't have the wherewithal. But of course, we know once they start serious, those states who are serious can always come on board and bring people who will handle all or some of these issues. So as it is, the VAT still rests in the hands of the FRS. But we know that by the side, some companies are being held to ransom by some states by collecting a double taxation that we know as consumption tax. Now, when VAT came on board, they used to call it sales tax. So when the states too came on board recently, they called it sales tax also. So when the case was in court and all of this, all of that, they now changed it to consumption tax. And that is why it's not everybody or it's not every line of business in the state that is now subject to sales tax or the consumption tax as the word is being used now. This is basically for hotels, eateries, then where you have relaxation spots. Those are the places now that are subject to consumption tax. But we believe in Nigeria, I think they need to come under one umbrella and probably go to court. The case was in court. They won the case and it was adjourned. But the state will still continue to collect this money until the final verdict is given. So that's that for jurisdiction. So when we go to VAT, we have, we've said that it's on spending. From the definition, if you remember, I said is every day, whatever we do, whatever we spend, a consumption, whatever we consume, whatever service, whatever good we consume is subject to VAT. But there are some basic items that once you subject them to VAT, basically some of these items are things that the government, we have what we call basic needs of man. That's the food, housing, and education. So that's what they looked at, basic needs, food, housing, and education. So on this basis, education was exempted from VAT. Then basic food items was exempted from VAT. Now, what do they mean by basic food items? Basic food item is you go to the open market, you go to normal eatery, you buy the people that are just cook and sell, you buy from them. The law says that exempt them from VAT. But on the other hand now, there is a case that allows basic food items to be subject to VAT. Why? Because if you've taken flour that should be for bread, you turn it to donuts, you turn it to meat pie. They believe that even that bread, they believe that once you take that bread to Mr. Biggs, you've added what we call value. And we know the essence of this tax, we call it value added. So what they are saying that the normal bread they sell on the streets, for example, we know the regulated price or the average price for bread is 500 naira, for example, on the streets. But if you go to the eatery, of course, they'll sell it for 1,500 or 1,000. So what the law is saying, in essence, that they've added value to that basic food item. Even the normal rice you buy, you cook it at home, or you go to a normal open place where they cook it, it's not subject to VAT. But by the time you go to somewhere else, some of these restaurants where you go to eat some plate of rice for like 20,000, 30,000, What they are saying now is that value has been added. So that is where we now draw the line between the basic food item and the same basic food item being a subject of VAT. So once value has been added, it's subject to VAT. Even water, there's a case between 7-Up Bottling Company Limited and the Federal Inland Revenue Service. Well, they were selling water. I've forgotten the name of the water they were selling as at that time. So they did a tax audit, and water was part of what was subjected to VAT. Now, what was the argument? The argument is that 7-Up has added value by bottling the water and all of that. But 7-Up won the case because the value they added was basically hygiene or health-wise. There's no way, how else do you want them to pack the water? Minus the pure water. I mean, bottled water is like the least you can do for this water, for people to drink it. So FRS, actually, 7-Up won that case. So that's why you see that if you buy bottled water at the normal price, it's not subject to VAT. But if you buy bottled water in the eatery or hotel or somewhere else, it will be a subject of value-added tax. So that is where we draw the curtains here and there for basic food items are subject to VAT. It's still trending. It's still a continuous issue that hoteliers, eateries are still arguing. Now, if you say this is basic, it's bread, I'm selling bread. So whichever way I sell it, I don't think it should be subject to. But the government saying no, the value you've added, even the price you are selling, it's not in open market price. So that's why they've not been able to win that case. But as the case is still trending, it's an issue that is still ongoing. But it's good that we know and where to draw the line. So part of the basic food items that are exempt from VAT or goods minus basic. There is a long list. There is a very long list done by customs for those who import all those basic food items. They have a code. It was stated there, and all of that. So, but what we'll do is we'll send that out later. Part of what we talk about again was the educational materials, baby products, even agric products, which still forms the basic food items, veterinary medicine, equipment for agriculture. They are all goods that are exempted from VAT. Then when you export, exportation is encouraged that we export, because once you export, you know, you bring in foreign inflow. That is foreign direct investment to Nigeria. So to encourage people to do exports, all exports are exempt from VAT. They are exempt. Then plant and machinery imported for use in export trading zones too, they are all exempt. Then equipment or machineries that have to do with agric, they are all exempt from VAT. There is a long list, a very long list. I'll send that out. Is more, in fact, that list is well broken down. There's an updated list. Once we have any new item that is exempt from VAT, that list is updated. We also have the 3 types of exemption actually is the goods are exempt, which we've talked about. And the goods that are exempt are based basically on the three needs of man, which is the basic food items, and part of the basic agri products, agri machineries that have been brought in to work in the agri sector. The basic food. Basic food are your gari, rice, beans, name it as it is. Then we look at services exempted. Before we go to services exempted, I want us to look at rent, because I mentioned accommodation, housing. Now, there are two things with housing. Housing can be used for residential. Housing can be used for office purposes. Then housing can also be used for, how would I put it, hotel. That's still for business. Now, the housing that is used, the house you stay for residential purposes is not subject to VAT. Now, the house that you stay for official purposes, for office rent, for office use, is a subject of VAT. Then the house you also use, for example, for hotel, rental, and all of that, is subject to VAT. We get that? Okay, let me go through that again. What we're saying now is that under housing, when we talk of the three needs of man, we've talked about education, we've talked about food, then we've talked about, now we're talking about housing, which is rent. Now, housing, if it's used for residential purposes, is not a subject of VAT. Housing. Ellen?
Go on. Somebody made a noise in the background.
Hello, can you hear me?
Yes.
Should I go on?
Yes, just go ahead.
Okay. So what I was saying is the housing, for housing used for hotel purposes, is subject to VAT. So does that for, then we will now go to services exempted. Medical services are exempted. Then when we say exemption, there are two types of this. There are some goods, these goods are outrightly
Can't hear you again. Can't hear your voice.
are exempted for VAT are medical services, that's the hospital, clinic services, and all of that. Medical include both the doctors, the optician, ophthalmologist, all of them. The services previously we have what we used to call community banks, then mortgage institutions. But as it is now, these are no longer in vogue or obtainable presently. So it is the microfinance banks, the corporate institutions, the cooperatives are now exempt. All these, there are some, what we call money lenders. There are money lenders. They have a license we call lender's license, which is issued by state to some small institutions. There is an institution that is common, is this one that gives loan to people. They call them LAPO. I don't know if we've heard that. There are some small offices that give loans. They give salary loans and all of that. They give loans to market women and all of that. They are all exempt. Those services, those interests, they are all exempt from VAT. Then services exported. A lawyer goes to work in the US or in UK and is paid. Such services are exempt from value-added tax. The services rendered by educational institutions too are exempted from value-added tax. But for education, for now, is not obtainable. They used to be exempt from company income tax all the while from inception in Nigeria. But as it is now, all educational institutions have been instructed to go and register as limited liability companies, and their income is now subject to company income tax. So I think as we progress along the line gradually, these services might now be subject. But I mean, that's the futuristic thing I think the government is looking at in future as it is. So we'll now look at zero rated. Zero rated. Now we've talked about goods that are outrightly exempted, then services that are outrightly exempted. Now let's look at zero rated. This means that the rate of tax, VAT, applicable to those goods is 0%. Those are goods or services purchased by diplomats or exported goods and services. These are zero rated. Zero rated goods and services are purchased by diplomats or exported goods and services. Then I want us to look at base value. Base value when it comes to VAT. So we've discussed under exemption, we are supposed to move to threshold. But before we move to threshold, let me quickly discuss base value, which I think we should be conversant with already. Base value now is what we refer to as our input, output, and input tax. Output tax is the tax. Output is the tax on your selling price. That is the tax you charge your consumer. While the input is the tax on your purchases. That is where you are a trader. That is where you do buying and selling. When you are into purchase of goods and selling of goods. So you have your base value now, you have an opportunity to do output and input. The difference is what you now pay to government. But if you are into services, you will only charge output tax. That still takes us back to definition where I say that tax has nothing to do with companies. Majorly is consumer. Is consumer. But a situation where the company consumes the good or the service, that company will be the one to bear the tax. Then I wouldn't know if I should expatiate more on output and input tax. I think we should be used to that already. We'll take our time. I don't know. Should we move ahead? Input and output tax is something we should be conversant with already.
Yes, please, let's move ahead.
Let's move ahead. Okay. Okay. So that's that for input and output tax. Now on exports, let's talk about exports before we go to for companies that import, not export. Now I mean import. When you import, they charge you VAT at the port, which is automated. So that VAT that is charged at the port is calculated on the total cost of the item, both the freight, the transport, the packing, and the commission on the total cost. That's how they compute the VAT on goods imported to Nigeria. Then when you also import, you know, some of us are auditors, so that when you see the CAC from M or the RA, you know how to calculate and get your figures. Then the foreign exchange too is converted at the Nigerian customs rate. That is the rate at which the goods are converted before charging your VAT is at the Nigerian customs rate. Then there are goods that when we bring them in at the point of entry, the price is below the open market rate. You know, some people will bring in goods, they might have paid, maybe you are bringing in a car, and the cost of that car in the open market, for example, is 1 million. Then you are now bringing in the car. When we say open market, we are talking of open market in the country or sale where you are bringing it from. When they check and you are now bringing it in at 200,000, the rate that will be used is the open market rate. The rate that will be used is the open market rate. So that now takes us to threshold. We know that recently the Finance Act 2020 has also VAT and also company income tax rates as is graduated now. So, but for VAT, once in a particular year, you don't make up to 25 million naira, you are exempt from VAT. What they are saying now is, in a particular year, you don't make up to 25 million naira, you are not subject to VAT. But it has lots of other branches. We know that in Nigeria, I won't talk of applicability. There's nobody that issues invoice without adding a VAT charge to it. I mean, how would company A know that company B's threshold is not up to 25 million naira? How do I confirm? Even when you call and say, company B calls company A and says, look, man, is your turnover up to 25 million? Why are you charging me VAT? Of course, the answer will be yes. Because at that point, the company A will feel that the VAT is for him. That since it's not up to 25 million, he's not supposed to remit, but he has deducted or he has charged and he's supposed to remit. So these are some of the trending issues. So what the law has stated, the clarity or the circular that FRS is following now is that, look, once you charge VAT, whether your turnover is up to 25 million naira or not becomes irrelevant. As far as you charge that VAT, you need to remit. That's number one. Then number two, what they now, for now, this takes us to, okay, from here, let's move to the current trend because of time. From the threshold, let's move to the current trend. The current trend on VAT now is that VAT is automated. VAT is automated. So in automating VAT, you file it on Tax Pro Max now. In filing on Tax Pro Max previously, you can key in just figures and you submit and you are done filing. Now the FRS expects us to be filling schedules. So if company A or company B, who was charged VAT, and company A refused to remit, goes to fill the Tax Pro Max portal, you'll put the schedule there that company A charged him VAT. and he needs to claim the input VAT in order to offset his output VAT. At first, when that circular came up, the FRS was like, Company B should endeavor that Company A remits the input VAT. But the companies now came up, everybody came up and kicked against it. But that means you want us to be doing your job as a tax authority. And they had a rethink and said, okay, what you will do for us, Company B, is that when you are filing your VAT, give us the details of Company A, so that if he remits or not, we can now know that we are going after him. They will now have an idea of what exactly he has collected on our behalf, and now know how to chase him. The issue of TIN number also came up, that there are so many companies operating without TIN numbers. They also brought the option of, if a company doesn't have a TIN number, put 0 there. That will also enable them go against. As far as the company has a traceable address, just impute, then they will go after that company. What we have on VAT, except that we have maybe particular areas where you want us to touch. Then part of the trending issues before we close for VAT is the non-resident companies. Usually, non-resident companies did not used to pay VAT in Nigeria because they will tell you that they don't have a base in Nigeria. So the act, that's a 2021 Finance Act, has said that, look, any company that does business with a non-resident company, the onus is on you to charge and remit to FRS. So once they discover that you did a business with a non-resident company and you did not charge, you'll be the one to bear the tax burden. Now that's for business to business. Now when you look at business to customers, that's still for non-resident company. It still boils down to the fact that you as a customer, as an individual or an enterprise, you don't have a TIN number or you are not registered with FRS. As soon as you are doing business with a non-resident company, you should register with FRS, which is even expected of you in the first place, for value-added tax purposes. So what they are saying now is, a non-resident company doing business in Nigeria with a company or with an individual, his services or the goods sold in Nigeria, it should be subject to VAT. And the onus to charge and to remit is on the company or on the individual resident in Nigeria. So those are some of the things I think that we need. What the areas you want us to touch on the VAT before we move on to capital gains tax, you are welcome. I hope the session is okay. I know we started late, so I'm trying to get the names. Can we move ahead? Mr. Okay?
Yes, go ahead.
Okay.
Or do we have any
Yes,
question?
go ahead.
Any question? Go ahead. Okay, okay. What of Mr. Musa? Are you okay? Any question?
Alhaji Musa.
Because I've been the only one talking, so I hope our participants,
We are
nobody is
hearing
sleeping.
you loud and clear.
Clear.
We are
Okay,
hearing you
okay.
loud and clear.
Just want to be sure that nobody is sleeping at this time, because I've been talking for too long, and at times could be boring, you know.
Maybe because VAT is not our major.
Oh, okay, okay. So let's go ahead. Let's look at so the final topic for the day before we go along is capital gains tax. Capital gains tax. In capital gains tax, we are going to be looking at basic issues. We know it's not an everyday tax, but I mean, it's coming up gradually. Even the FRS too, many of them don't really know how to make sure that companies or individuals comply. But the FRS has woken up to this duty, and I mean, it's fast trending among them, and they are tending to the issue as it is. But for the states too, they're supposed to charge capital gains tax, but I don't think even Lagos State, that is a trailblazer when it comes to taxes, I don't think they're looking at this at all. It has not come within the purview of the state to make sure that everybody is compliant when it comes to the capital gains tax. So on capital gains tax, we're going to be looking at introduction of capital gains tax, assets that are chargeable, disposal of assets, compulsory acquisition, computation of the gains that should be subject to capital gains tax, then the gains too that are not chargeable. They will now talk about the basic concepts of capital gains tax, because it has capital gains tax has two legs. It's a standalone tax, then at the same time, it corresponds with what you do with your capital allowances in terms of computing your assessable profit or total profits, which will be subject to education tax and company income tax. So right away, we'll start by looking at it came on board in 2004 as capital gains tax cap C LFN 2004, and is to be administered by both the federal and the state internal revenue service. But for now, the state is more of, and what the states even look at basically is when assets are disposed at the volume or at the value or at the point of looking at your financial statements. They look at your capital like, okay, this asset that was there, now it is gone. Where's the sales proceeds and all of that? And why the FRS is particular about capital gains tax is because there's what we call sales proceed. Once you sell an asset, there's a sales proceed. In computing your income tax payable, sales proceed is exempt from company income tax. Sales proceed is exempt from company income tax. So that is why the FRS is particular about CGT. So the question now is, if you exempt it from company income tax, where did it go to? The other leg is that it should be subject to capital gains tax. So that's why once they don't see it here, they must see it here. Or what is the treatment given to it, which we will get to? Is it a balancing charge? Is it a balancing allowance? So that's why you see that the FRS is more up and doing when it comes to capital gains tax. But they can do more, I tell you. Capital gains tax administration is way, way, way behind what we expect, except for the digital world that has made it very obvious. Okay. Now, FRS is actually in charge of disposals by corporate or limited liability entities, while the state is in charge of disposals by individuals, enterprise, or sole traders, let's put it that way. enterprise or partners who are in partnership. Part of the introduction, we look at the rate of capital gains tax is a flat rate everywhere, both the state, both for individual, both for company. Is a rate, 10% rate. 10% rate. 10% rate. Now, there's something I want to mention. There's a difference between the sales proceeds and the amount that is subject to capital gains tax. I want to mention it at this point. Now, the sales proceed is the total amount you earn from selling an asset. Let's use a building, for example. Now, you sell a building. In selling that building, maybe you got a lawyer, you got an agent, lawyer to draft agreements, you got an agent to look for buyers for you. You also renovated that building. There's a renovation cost. Now, the sales proceed is the total amount you have gotten. But the gain that is subject, the capital gains that is subject to CGT will be net of all these expenses. So there's a difference between the total payment. For example, you renovated a house, you got a lawyer, you got an agent, maybe you did some other incidental costs so that to prep the house in order to sell. You now sell that house for a cost of 100 million, for example. Now, the other total cost of the lawyer, legal fees, the agent fee, agency fee for people who went to look for buyers for you, then the other incidental cost is 20 million. The sales proceed is 100. The capital gains will be 80. So there's a difference between your sales proceed and the capital gains. So let's move ahead. I just want us to clarify that because it's always an issue. Now, the assets that are chargeable to capital gain in Nigeria are options, debts, incorporeal property. Generally, what we are talking about here are shares, options given to someone to sell a property on your behalf. We are talking of stocks. You know, there are some companies, what they do is that they buy shares, they buy stocks, some buy shares in their fellow subsidiary. The subsidiary might not be doing very well, then you sell it off. All those monies are subject to capital gains tax. Then any form of property created by a person, disposing it off, or otherwise coming to be owned without being acquired. A property created by a person, disposing it off, or otherwise to be owned without being acquired. When we say without being acquired, that's you own an asset. Now you are giving it out, or by way of that, somebody now acquires that property. The law expects that it will be a subject of capital gains tax. Then there are some other assets disposed that will be subject to capital gains tax. Where any capital sum is derived by way of compensation for any loss of office or employment. Now, we are not looking at selling of assets, selling of shares, selling of stocks, and all of that. What we are now looking at is other issues relating to assets or properties. Now you lose a job, you are being paid for losing that job, or compensation for loss of office. But in all of this, there is the Finance Act 2021 has given, before, the loss of office compensation or loss of employment. When we say loss of employment, also means where you work. That is where you earn your income. Before, now, it used to be 10,000 naira, but it has been increased to 10 million naira. So any amount that exceeds 10 million naira, below 10 million, will no longer be against tax. Then where any capital sum is derived under a policy and the risk of any kind of damage or injury or loss or depreciation of assets, these are insurance payments. Those of us that are doing it, in the oil and gas sector, also manufacturing companies, there are machinery. Some those are capital costs. So they insure some of these assets. When any capital is returned or for future or surrender of rights for refraining from exercising rights. These are shares issues. All of these are coming up now because of the digital space. The digital space. We have to be looking at how good, how well the revenue can monitor some of these people. That's what we're looking at now. There's lots of trading ongoing. So many of us are into foreign on our behalf. Some, we do the trading ourselves. So this is where government too is looking at. Those who buy and sell online. So that's what the government is now trying to capture. Previously, our law is digital income. They look at some of these things. So they try to bring it in with the new Finance Acts from 2019 till date. So says where any capital sum is received in connection of any trade, business, profession, or vocation. We are still saying the same thing. All this has to do with more of when you say business, profession, or vocation, or trade, all this has to do with the non-regular areas. Previously, capital gains tax was more of either shares, stocks, or you are talking of building. So now they've expanded all of this to like trading, to like your farming, to agric. All of this now brings in the agric business into the issue of capital gains tax. So the capital gains tax is still evolving. As we progress, it's evolving. Because with the digital space, I tell you, there are lots of businesses that are here to still be captured. So we now talk of a person shall be chargeable to tax if he acquires or disposes a land to an authority exercising or having powers, if that person had not. Now, what we are saying is, for land, this still has to do with the old capital gains template that looks more into land and building. So what he's saying now is that if you have disposed your land due to government intervention, or government forcefully takes your land from you, that is not subject to VAT. That's what we're saying. But now, you know what happens? Some people will know that this area is government area. Some people are privy to know that by next year, there is an internal circular that says that in Ojodu, we are going to be selling these properties off. Government wants to acquire this place, but in the course of acquiring, we're going to compensate these people. So because you as an individual, you are privy to this information, you now go and buy the land after the issuance of that circular, knowing fully well that that land will soon be acquired by government. That amount will still be subject to capital gains tax. That's if government pays you. Let me repeat. If government compulsorily acquires your land, it is not subject to capital gains tax. What government is saying is that by the time they do their own investigation and discover that you only bought that land because you knew, you had prior knowledge that government was going to acquire that place and compensate, that compensation will still be subject to capital gains tax. So let's move ahead. Let's look at, we've looked at disposal of assets, which are other assets that can be chargeable to tax, such as compensation of office and all of that. Compulsory acquisition of land. And let's look at computation of capital gains tax. So we'll say computation of capital gains. This is the difference, not just difference. The difference can be a loss. So we can't say difference. What we say is positive. Capital gains is a positive difference between the consideration on disposal and the original cost of the asset. Capital, let me come again. Capital gains, not the tax. Please take note, not the tax. Capital gains now is the base value that is subject to capital gains tax. That's why I defined at the beginning the definition of capital gains tax. I defined the difference between sales proceeds and the capital gains. So now we are moving on to capital gains. Capital gains, that is a positive difference. Note the word positive. I will explain that shortly. Between the consideration. The consideration that is accruing is what we know as sales proceeds. Sales proceeds that I defined above. But why we are now calling it a consideration is because the proceed might not be cash. On disposal, that is when you dispose the sales proceed and the original cost of the asset. You can buy an asset, take for example, a motor vehicle. But motor vehicle is exempt. Take note, that's a very peculiar one. Motor vehicle that has 4 legs for personal use is exempt for carrying of people from, we'll get there, from capital gains, but it's a peculiar one because some companies in computing capital gains usually include motor vehicles, but motor vehicle is exempt from capital gains. So let me cite an example with a motor vehicle, because if you talk of land and building, normally it appreciates. So what we are saying, I want to define the word positive here. Why we say capital gains is the positive difference. That's what I want to highlight here. When you purchase a motor vehicle, it depreciates. So at the point you are selling a motor vehicle at a price lower than what you bought it, there is no capital gains. Let me cite with figures. You buy an asset, 200,000. Now you are selling it at 100,000 naira. There's no capital gains. Yeah, that's what we're talking about. Then where there is a gain, there are some expenses, just as I stated above. We have not computed our capital gains. We have our sales proceed, less the original cost, less the following expenses: expenditure wholly, exclusively, and necessarily incurred for the acquisition of the assets. Then incidental costs on acquisition of the assets, like the legal costs, the agency costs, those are incidental costs, wholly, exclusively, and necessarily incurred, are like renovation. The building has no roof, you need to paint. Those are necessary costs you must incur. Those are costs that help to enhance the value of the assets before disposal. Then costs incurred on assets for the purpose of establishing, preserving, or defending the title or right over that asset. Peradventure, you have a building and there's a court case and all of that. The monies you spend to win that case, to show that you own that asset, all those things are, though all these costs are liable in computing your capital gains. Now let's talk about gains that are not chargeable if it accrues. Now, any gain that accrues to a church or an educational institution is not subject to capital gains tax. Now, when we talk of trending issues or current trends, this is an issue that is trending currently, because from year 2020, educational institutions have been told to start paying company income tax. And meanwhile, capital gains tax is an offshoot of company income tax. So what we are seeing here now is that the educational institutions are subject to company income tax, but exempted from capital gains tax. So when we also talk of exemption from capital gains tax, we talk of gains accruing to ecclesial, that is churches or charities. Then we also have registered friendly societies that are not subject to capital gains tax. Then the cooperative, just as we said before, cooperatives are not subject to, that are registered by the law of any state, like the money lenders and all of that. They are not subject to capital gains tax. Then we have trade that is not subject to capital gains tax. Hello, did you hear me? Hello?
Yes, we're hearing you.
Okay. It's not subject. That's trade union registered under the Trade Union Act, not subject to capital gains tax. But however, if some of these people own businesses outside their scope, that is, for example, what used to happen before, a school will have, let's say a school or a church would have a bakery. Then maybe the head of the church is the director of that bakery. So what we are saying here now is that bakery, even under CAC, we know there is a church that owns it, will be subject to CGT or capital gains tax or company income tax. That's a caveat too in the capital gains tax. So they are connected to any trade and they do any business, all these societies, it will be chargeable. Then we also have local government councils. Local government council, any gain according to local government councils from assets sold by them is not subject to capital gains tax. Then investments in superannuation funds, such disposals are not subject to capital gains tax. Then the pension, those are still like government parastatals. The pension, SITF, ITF, all the parastatals, once they sell their assets, they are not subject to capital gains tax. Then award given to gallant soldiers, decoration of award, payments for those awards, compensation based on award giving are not subject. When you sell it, you know, there are some people, they give them medal. Nigeria gives a medal, a gold medal. Then you now go and sell it. It's not subject to capital gains tax. Then there are some areas that we need to talk about when it comes to capital gains tax in terms of exemption. Let me look at this. Yes, when we say gains, not chargeable, then we can also talk about exemptions here. We've discussed exemptions for loss of office or damage suffers. Once it is below 10 million, is not subject. Once it's above 10 million, is exempt from capital gains tax. Then if you remember, under VAT, we say a private residence of an individual is not subject to capital gains tax. Then gifts too, just like the medal received, are not subject to capital gains tax. Then gains accruing from a unit trust, that is in respect of disposals in a unit trust, they are not subject, but they have to be reinvested. So these are areas I want us to, when we talk of reinvestment, now under capital gains tax, there's what we call rollover relief. And that is why I said even the government, they still have a lot to do when it comes to capital gains tax. Now, let's look at the practical aspect of the rollover relief. In terms of academics, in terms of the law, rollover relief has a time span, except to keep rolling over. But is it applicable to most companies? No. But on the average, most companies, when they sell an asset, they will claim a rollover relief. Now, how would government confirm? The FRS doesn't confirm. That is saddled with this responsibility. What usually happens is that most companies will compute. Then at the time you are supposed to charge the 10%, you will see rollover relief. That they rolled it over, they bought another asset worth that same amount. And not just that same amount, it has to be the same class of assets. And what the law also states that, minus being that same class of assets, that asset must be purchased within 12 months of that disposal. That is when you can claim a rollover relief. So, but now, most companies, what do? Everybody claims rollover relief, whether that asset has been or not, and the revenue just can check for, can still can still go into in terms of raising revenue.
Your voice is off.
No.
Yeah,
Then in terms of rollover relief, the class of assets affected for fixed plant and machinery, ship. Hello? Hello?
I can hear you now.
Can you hear me now?
Yes,
Okay.
yes.
Okay. So I said to claim rollover relief, we have three major areas we look at. Once you sell that asset, you have to replace within 12 months from the sale of that old asset. That is first criteria. The second criteria is that the asset you are going to purchase must be in the same class or category of assets that was disposed. That is the second criteria. Now, the third criteria is that there are some assets specifically stated in the act that you can claim the rollover relief. Such assets are building, land, fixed plant and machinery, ships, aircraft, and goodwill. So after all this, that's all we need to know on capital gains tax. But before we wrap up, one more thing to go. I said we are going to talk about concepts as it relates to capital allowance and capital gains tax. Now, sales proceed, as I said, I keep mentioning sales proceed, is less historical cost of the asset equals capital gains. That is the gain that is reflected in the financial statement. I hope we got that. Now, what we are saying is the sales proceed, as explained earlier, less the historical cost of that asset and all other incidental costs in selling that asset gives you your capital gains. That capital gains is what is stated on the financial statement for audit purposes before it is being adjusted for income tax computation. So that capital gain, which we call sales proceed or profit on disposal or loss on disposal, is the sales proceed less the historical cost of that asset. So when it's positive, it becomes a profit on disposal. When it's negative, it becomes a loss on disposal. That is what is reported on the financial statement, but not for tax, not for company's income tax. And that is why under your company income tax, when it is a profit, you less. You don't adjust it for company income tax purposes. Then for sales proceed, two, now we are looking at the tax aspects. We've looked at the audit or accounting aspect of treatment of the capital gains or the sales proceed. Now, if we proceed to tax, it will now be sales proceed less the tax written down value of the asset. What we computed in the financials as our sales proceed is not subject to tax. It's not adjusted for tax purposes. Now, what comes into tax is the sales proceed less the tax written down value. I want to believe we all understand what the tax written down value means. Tax written down value is the cost of an asset less the capital allowances claimed over a period up until when that asset is sold. So that capital allowance, the sales proceed less the capital allowance claimed so far. The cost of the asset less the capital allowance claimed so far gives you the tax written down value of that asset. Cost of the asset less capital allowance claimed till date of disposal gives us what we call the tax written down value. Now, when we now get the tax written down value, we now calculate sales proceed, not cost of asset now. Sales proceed less tax written down value of the asset gives us a balancing allowance or a balancing charge. Balancing allowance. Balancing allowance, if the sales proceed is less than the tax written down value, it becomes a balancing allowance in the computation of the income tax. That's what we're saying now is if the balancing allowance, if the sales proceed is less than the tax written down value, it's an advantage. What we are saying now is that the proceed you got is less than the tax written down value. It becomes a balancing allowance. Now, balancing allowance means that you less. It's an allowance. You less. It's an advantage. You less from whatever taxes you are going to pay. But it doesn't affect education tax. I'll get there. Then we have balancing charge. Balancing charge is when the sales proceed is greater than the tax written down value. Balancing charge is when the sales proceed is greater than the tax written down value. The balancing charge is added to profit for income tax purposes. The balancing charge is added to profit for income tax purposes. So that is why revenue is always particular about capital gains tax. Why? Most times, except where the asset is sold before completion of its useful life. You know, most assets, take for example, for land and building, the useful life is 10 years, 10%, because depreciation rate is different from capital allowances rate. So what we are saying under taxation, under capital allowance computation, is that even the land and building, which has the longest useful life, is just 10 years. Then we now have furniture and equipment, it's just 5 years. Then we now have plant and machinery or computer equipment, it's just 4 years. And in computing your capital allowance after 4 years, that asset becomes 10 naira. That is the net value, single value is 10 naira per asset. So by the time an asset is worth 10 naira, definitely the sales proceed will be greater than the tax written down value. So usually where you have balancing allowance is when that asset, the sales proceed is lower, and this hardly happens because within 4 years, I mean, you've already claimed your allowances before that asset is being sold. So that's what we have for today. Your capital gains tax under company income tax, under when you compute your balancing charge or when you compute your balancing allowance, is not considered in arriving at education tax. It only affects the assessable profits. It doesn't affect the assessable profits. It comes after the assessable profit. That is when you bring in your balancing charge. or you adjust for your balancing charge. But we have cases where the revenue will compute and bring the balancing charge before the assessable profit. That means that your education tax will be higher. So it's a point to note in case you're under audit, you cross-check the computation of the income tax, a situation where the balancing charge comes before the assessable profit, make sure you tell them to adjust, because that automatically means that your education tax has been increased. So I know we have tried staying on. Quickly, that's what we have for capital gains tax. Hello, can you hear me? Hello?
Yes.
Okay, you can. Okay. So before we go, or before we go into question and answers, there is something I want us to note. You know, we do companies nowadays trending, we do lots of leasing. Leasing has also become an issue, lease business. So I just put it under general for since we are in offices for practical sake. Under lease, we have what we call finance lease. Lease. Under finance lease is when you lease. Operating lease is more like rental. That's what operating lease is about. So under the finance lease, I'm going to discuss withholding tax, today's topic. I'm going to discuss VAT, today's topic. I'm going to discuss CGT, today's topic, before we move on to operating lease and discuss same topic. Finance lease, when you compute, the withholding tax is on the interest amount only received by the lessor. That is the person operating the lease. VAT earned by the lessor because it's a return on investment and is not subject to VAT. Sorry, VAT is not, the interest on finance lease is not subject to VAT. Then for capital gains tax, if the asset is disposed of after the leasing period, any capital gain realized will be subject to capital gains tax. That's what we're saying is, of course, under finance lease as a lessor, there's no way you can dispose of the lease. That will lead to breach of contract. So, but what we are saying here is that after the lease period and that asset is being disposed, it will be subject to capital gains tax. Under operating lease, withholding tax is 10% of the total rental amount. Under operating lease, withholding tax is 10% of the total rental amount. Then for VAT, the total lease rental income is also subject to VAT. So thank you very much, everybody. I hope I didn't have, you enjoyed the lectures. It was not too boring. We were as practical as possible. And we have questions, let's have them. The ones we can answer now, yes, we'll do. Then the ones we send to you via online, we'll get back to you.
So the first question, I wanted to add something to
Okay.
I don't know. You see, we've discussed withholding tax, VAT, and capital gain tax. Now, at the introductory level, Clement mentioned a lot of documents that support withholding tax, like the Personal Income Tax Act, yes, the Company Income Tax Act, the Petroleum Profit Tax Act, and
no, I mentioned these sections.
Yes, you mentioned all the sections. You mentioned all the sections. Now, what I want to say here, that particular withholding tax is not a tax on its own, but rather
No,
an
it's not.
payment of income tax.
Yes,
So,
yes, exactly.
so there are some times where you might get to a point where the FIRS guys will want to force you to pay additional tax. Okay, for instance, I think some of us are into relationship with foreign entities, where those foreign entities might give us loans. Say, give you a loan, foreign loan. A foreign loan comes into Nigeria, and that foreign loan is subject to interests. You should apply some interest. So that interest element, the FIRS guys will want you to pay withholding tax on it. Now, there are some laws aside from these ones that have, for example, the Nigerian Investment Promotion Council, and NIPC, something like that.
Yeah.
It exempts some income from some foreign income from taxes. So, for instance, if that foreign loan was actually brought into Nigeria through the CBN, and they got this CCI,
Capital Importation Certificate.
Correct. And that loan is about 7 years tenure with at least 2 years moratorium.
Period, yeah.
And the contract supports all this. And most likely, when you look at it properly, the NIPC rules exempt it from even their withholding tax, because they are trying to encourage foreign direct investment into Nigeria, and they want it for a long time. So it's not going to be 2 years loan; it must be up to 7 years and above. So that is some area you might need to look at when you are trying to defend your tax exposure, especially your client tax exposure. You need to look at that, because some of the contracts you have, which your clients have, already have those clauses in there, but they might not even know until you review the contract.
That's a good one, Mr. Enam. You discussed earlier.
Yeah.
Another issue I want to discuss that you just brought up, that I discussed even earlier, still boils down to documentation.
Yes.
Let me give you a clear case. Now, some of these companies, what happens at times, some of them start this process halfway with CBN and they don't end it. Those contracts are not properly documented. And that's why I mentioned earlier that it's good to always get a clarity or a second opinion from a consultant when you are going into some certain businesses. I mean, you can have all the advice, but your documentation at the point you are arguing with and some of these figures could be huge. Some of these interests at times are foreign currency denominated.
Very, very huge.
So, I mean, that's why I continue to talk about documentation goes a long way. Some of them don't finish this documentation. Some have these documentations, they don't keep them properly. By the time you're asking for it, MD will tell you, I gave the accountant says, MD is in your purview. I mean, these are areas minus having all of this documentation. If there's anything I want us to take home today, that's why I also discussed about that vendor list. So many of us, our vendor list is very, I would not say so many. Some of us, our vendor list is not correct the way it should be. You have names that are not. It's like there's an advert they do now. There's this Money Point advert that says that your business name is different from the name your account or something like that, and the guy ends up not paying you your money and all of that. So this is a very valid point, please.
Thank you so much, Clemens, for the job well done. Any question?
Hello?
Yes.
Yeah, sorry. Good afternoon. I mean, good evening. Sorry. I've not spoken on the word, but I have a question. My name is Doyin. Okay, so my own question, it's not really a question, maybe a form of clarification. So we have vendors. When vendors send in invoices, like our suppliers, they send in their invoices with VAT on it, right? 7.5 VAT. So this issue was not I think it was not an issue when VAT was still 5%.
Yeah,
So
nets of itself.
So yes, net. So by the time we are paying, we also want to withhold, withholding tax and then also remit on their behalf. So it nils out. But now that VAT is 7.5, if we take out withholding tax 5%, the remaining 2.5 on the VAT.
Yes.
Of course, I mean, you know, so I for me, I think the headache is really at the point where you know, when FRS comes for audit and all of that, and they're like, oh, you know, there are conversations around, there are times you self-charge, you do, you know, all of those parts is always very cumbersome for me. So I don't know if you can help throw more light, you know, so that going forward, most of this, and then the second question is when you are dealing with individual vendors who have business name, but of course the business name, no, they don't even have tax identification number and all of that. But at the point of payments to those vendors or suppliers, they present their personal names. I mean, their personal bank accounts for payment. So for them, are we just supposed to take out the withholding tax? And I think where the headache is there are times we are based in Lagos. My company is based in Lagos, but there are times we have vendors from around all over the country, and then so maybe somebody based in Abuja, and then is a personal business name and all of that. How when we're remitting the withholding tax, is it going to be state or federal? Yes, state, but which of the states? For example, I dealt with a vendor from Abuja. So am I going to remit the withholding tax to Abuja or Lagos? So all of those, you know, I just need help or clarification on that, please, if you understand my question, sir.
Yes, it's very clear, very, very clear.
Thank you.
Okay, let me take it up from here. Number one, let me start from the last one that says, where would the taxes be remitted after deduction? Well, sorry, I didn't mention from beginning that tax has to do with residency. That's how resident, non-resident, itinerant workers. The tax law, when it comes to itinerant workers, is a bit complicated. That says that when you spend 183 days in a particular place, that's where your taxes should be paid. But let's put a general rule to it. Now, if you have sent me an invoice and that invoice shows, because that's what the tax authority will look at, is address on the invoice. So if the address on the invoice shows Ondo, I'm paying to Ondo. If the address shows Abuja, I'm paying to Abuja. For Ondo is okay, Ondo and Abuja. Now Abuja is like every other state. Ondo, once is an individual, will pay to the State Internal Revenue Service. Then once is a company, you pay to Federal Inland Revenue Service. Now, Abuja, residents in Abuja before now used to pay to Federal Inland Revenue Service. But as it is, they've created what we call FCT IRS that collects taxes relating with withholding and employee tax relating to individuals, partners, who are in partnership, and enterprises, business names. So, but if it's a company you are dealing with, or maybe a military personnel or the police, then it has to be paid to Federal Inland Revenue Service. Now, the issue of vendors bringing their individual names. Now, most vendors will not charge you, especially when you're dealing with individuals or itinerant vendors. Onus is on you to charge withholding tax, because the VAT that they did not charge you, to you is like an advantage, because the onus is not on you. Depends on the nature of your business. Now I'll come to that. The onus or the tax obligation to deduct and remit the VAT on that vendor's invoice is not on you. So you don't have any issues with that. What you now have issues with is the withholding taxes. And that's why I was explaining that some of these vendors, some just need some lectures, some are just adamant, some don't want to do it. But that same vendor, if he has business to do with Mobil or an oil and gas company, he knows that they're going to charge him withholding tax. That same vendor, if you send him to UBA that come and register as a vendor with UBA, he knows already that they're going to charge him withholding taxes. You get the logic. So it's about, I think, information, convincing them. Some of them, I mean, if a vendor is doing volume of business with a company, I'm sure will not want that relationship to go because of the company's policy. So it's I knew there was a draft we did about withholding tax. So what the company now did was email all the vendors, paste it at their point of entry, point of vendors collection and all of that. At a point of, it's a very big supermarket where they collect products. Where they collect products, they pasted it everywhere so that everybody knows that, look, because the company was tired of bearing the withholding taxes for the vendors. So what they now did is, look, Mr. Clement, look, forget about all these price, this service charge. No, we do this one, the total amount, we are hitting them straight. So they did that for some time. The vendors who came together and started fighting the company, come on, you can't do, because they too, they went back to get some kind of opinion as to what is happening. Is this one happening in this other supermarket? Is this so? They now told them, they came back. And I mean, they're on good standing with each other now. So that education of vendor is very important. Just as I said, nobody wants you to deduct withholding taxes from their money. So it's not a TikTok that you feel is chat and chat. No, you don't chat. You have to be you have to be soft, but at the same time, they need to understand that this is now the company policy. So I think that will do for the individual vendors. Then for the invoices, of course, to you now, it's like a disadvantage. You are paying more. The company now is paying more. You are paying a 2.5% increase on all your invoices. That's what it means automatically. And it's the law. It's the law. It's a tough one, but it is the law. Unfortunately, the truth is that most of these invoices that you pay, some of these people might not even remit the VAT. That is the painful part of it. Just as I said.
Exactly.
Yes, there's a threshold. There's a threshold of 25 million. That 25 million, I tell you, so many companies, some of these vendors, even the registered companies, are not netting that 25 million and they are charging VAT. They are not remitting. Even the revenue knows. You know, revenue now has access to back end of companies. All they need is just the BVN and they will check. So they've noticed, and that is why they now employ everybody. So what you do now, if it's an input tax, it's easier to bail the cat. If it's an input tax, it's easier to bail the cat, okay? But if you are the final consumer, take for example, I'm your auditor, you are paying me audit fee. The audit fee, you are going to charge it to your P&L. So you are the final consumer. So that is where the problem now comes in, that you are paying that 2.5% higher. So it's something that is difficult though, and you don't have control over it, because in Nigeria, of course, you can't say you want to pay a bill without the VAT charge on it. What I will encourage going forward is you should come up with a policy where every company, that's why I talked about that vendors list. Let's drop a vendors list and you put a policy that, look, I don't want to be, even if you want to be an individual, you should go and get a business name. The beauty of a business name now is the fact that for every company, whether NGO, business name, limited liability that is being registered, you have an automatic tax identification number. So it's no longer that you are interested in the number or not. Hello, did you get me? So let me repeat myself.
Yeah.
I said,
Yeah, please repeat it. Yeah.
okay. I said the beauty of it now, once you do that policy, is that every company that has been registered since 1999, has a pre-registered tax identification number, so they don't have anywhere to run to. So once you send that name to the tax office, they will give you the TIN
With
number.
business names. Those
Yes,
with
even
business names.
yes, business names,
No,
NGOs,
no,
and limited
business
liability.
business names and NGOs don't come with that. You still need to go for the
No,
team.
they do. No, they do. They do.
Okay.
Is
I'm
there a
very sure
recent
they do. Yes, it is. They do. Every company, there's no company you register now that does not come with a tax identification number. What happens is that you might not see the thing maybe on the certificate of incorporation. But once you send that name with the business name to the tax office, that identification number of that company will come out. You see it. There is no company. Once you generate a name, it's automated, it's automatic. It's automatic because nobody is exempt from VAT anymore. Even the non-residents that used to go away from everybody, nobody is exempt from it anymore. So I think that answers your question. If it's okay by you, let me know.
Yes, thank you very much.
You're welcome, madam. So at this point, I think we can.
So thank you so much. Thanks everyone for the patience and understanding, especially as we had to reschedule to this moment.
So, sorry, can I just chip in something?
Yes.
Okay.
Yeah, so as it concerns vendors, you know, because not everybody is very enlightened. Sometimes we have gone ahead to, you know, just enlighten, especially if you are dealing with very local vendors
Yes,
who don't see any need. They just believe that you want to work, you want service, I give you service, pay me my money. So they don't know there are procedures they're supposed to follow. What we have done from our own end is we have designed forms that before we even engage you, like at least Mr. Nnamdi can testify to that. Before we engage you, you must fill out those forms. You must. So it's at that point that we'll know if you're a limited liability company, if you have a TIN number or not, if your registration are not correct, it's a red flag. You're not even brought on board at all, no matter how important that service is. So that takes that headache away of pursuing somebody to come and to send in good documentation. So at the beginning, if your documentations are not complete up to the minutest detail, if you don't send it in, there's no point doing business with you from the beginning. So I think over time, it has helped people who have worked with us as vendors to realize that these things are not, they're not like, it's not a vague thing. It's something that must be done.
Exactly.
I think that's what has helped us from the past experiences. So we cut off that wahala of trying to get people. You have to do this, and then sometimes payments will be made. We don't even make payments before services. That's one policy with us. And then your bank must be your business name or whatever. It must be, because your shareholding must show in the forms that you give to us. Your shareholding, how the company is formed, everything will be presented. So from the beginning, we already have a hold of what we want. And if there's nothing if it's not complete, then you can't be a vendor with us. That's what we do.
So,
all right, thank you for.
We have Mr. Okay. Okay, his hand is up. I think he has something to say too. Go ahead.
Yeah.
Hello, Clement.
Hello, good evening, Mr. Okay.
Good evening. Thank you very much for doing a very nice job. I just want to confirm that on a particular disposal of an asset, you do the balancing charge or balancing allowance. It's a different matter. And then you also do the CGT, and it's a different matter. Hello.
Hello, sorry, I was the network.
Okay, I said I want to confirm that if a particular asset is disposed of,
So
you compute the balancing charge, balancing
go back.
allowance. Hello?
Okay. Hello, yeah, I can hear you now.
Okay, I said
Can
that
you
I
come
want to
again, sir?
confirm that
Okay.
on a particular
Particular
disposal,
asset. Okay, okay.
you compute the balancing charge or balancing allowance.
Okay.
It's a different issue.
Yes,
And
yes,
you
it is.
and you compute the CGT, and it's a different issue.
Yes, sure.
So the two of them on the same asset disposal.
Yes, it's a different issue. Hello, can you hear me?
Yes, I can hear you.
Yes, it's a different issue. I was just trying to relate part of company income tax with the capital allowance and capital gains. That's why I called it other basic concepts.
It's okay.
So do we still have questions or comments? None. Okay. So thank you so much, everyone, for your patience. We have other company income tax next week, personal income tax on Sunday, Saturday, I think on Saturday, yeah, Saturday by 3. So, and there are other things next week, so we'll keep you posted. So thank you. We'll be having a WhatsApp platform where we will put everyone. You will have the option of joining though. It's from the email that was sent to you. You see the link. When the slide is ready, we'll also send it. So thank you.
Mr. Nnamdi, you mean the PIT is tomorrow?
Yes, by 3. Thank you.
Okay. Yeah.
Have a nice evening.